Today we're going to dig into Devon Energy to find out whether it's a buy or not. It trades on many exchanges around the world, but in the US it trades under the ticker DVN. As always, don't take this as investment advice and always do lots of your own research before investing any of your money. In a little bit, we're going to talk about Devon's cash flows and Devon's valuation, and I think that's going to blow you away. But first, let's talk about why invest in oil and gas right now. First up is lack of investment worldwide in oil. The industry, including the state-run oil companies, are under-investing in oil by more than $1/3 trillion per year. So because of this, they're not going to be able to maintain production going forward at the same time that the world's population is growing and at the same time that more and more people are coming out of poverty worldwide. So there will be more and more of a demand for oil in all likelihood. Because of that underinvestment, oil prices are likely to remain high. Next, you have the gas price arbitrage. Right now, 1 million BTU of natural gas in Europe is selling for about $9. In the US, the Henry Hub spot price for natural gas is about $2 per million BTU. So you have a $7 difference between the US and Europe. And you know what? The infrastructure to get the gas from the US to Europe is being built right now. And as we start selling more natural gas in Europe, the price of gas in Europe will go down and the price of gas in the US will go up, which will benefit a US producer like Devon. And next, in the oil and gas space, you have incredible valuations, at least in the US and Canada. And we're going to get to the valuation of Devon here in a little bit. And then you have the Matterhorn pipeline that's being built, and it's going to be commissioned in Q3 of 2024, so very, very soon. And this is a pipeline that goes from like East New Mexico or West Texas to the greater Houston area or the Katy, Texas area. And the reason this is important is because Devon is a big producer in the West Texas and East New Mexico area. And there is too much gas being produced there. So much, in fact, that they have to burn a lot of the gas that's being produced because they have nowhere to send it. However, after this Matterhorn pipeline is built, they'll be able to send a lot of it to Houston, and they'll get a much higher price for that because actually West Texas natural gas is selling for a lower price right now than the Henry Hub spot price. So that Matterhorn pipeline should bring revenues up for Devon. And as a matter of fact, Devon is a partial owner of the Matterhorn pipeline. And the next reason to invest in a company like Devon or in the oil and gas space is that businesses and industry in the US is converting to gas. So this is especially going to help a company like Devon who has a lot of exposure to gas. Right now, they're making most of their money from oil because the gas prices are so low. However, you have all this industry and all these businesses that are converting their operations to gas because gas is so cheap right now. So this is creating a lot of extra demand that's happening right now. And next, we have a potential political catalyst, and that is if the Republicans win in 2024, I think oil and gas producers in the US will be valued higher in the market. So that could have a positive impact on the share price this year. And now why we might want to invest in Devon Energy. First of all, they're investing enough to maintain or grow production. A lot of these oil and gas companies aren't reinvesting enough in their business, and they're actually cannibalizing their business. You'll see some oil and gas companies, especially the state-owned companies, paying crazy high dividends, but they're only able to do that because they're not reinvesting in their own business and reinvesting for the future. And because of this lack of investment, you want a company that's investing for the future so you can take advantage of those future high prices. And Devon is forecasting that they're going to be able to reduce costs by 10% in 2024. And when you can maintain production while at the same time decreasing your costs by 10%, that adds a lot of extra income to your bottom line. And when you have a higher number on your bottom line, that means more dividends and more share buybacks. The next reason is Devon has heavy insider ownership. Between the executives and the directors, almost all of them own like 10 times their annual salary plus bonuses in shares. And 10 times their annual salary, well, that's pretty rare to see. But that's a very good thing because that means that when management makes decisions, you know that it's going to be in the best interest of the shareholder. Whereas a lot of times when the top management doesn't own much stock, they're making decisions that are in their best interest, not in the shareholders' best interest. The next reason we might want to buy Devon today is because it's super cheap, and we're going to get into the valuation here in a little bit. And also you have low tax rates. Devon's average income tax each year is about 20%. Whereas, for example, if you invest in a Canadian gold producer, that average income tax rate is going to be 30% or 40%. And in addition to this, at least for me as an American, I have an advantage because when Devon pays out a dividend, I'm not necessarily taxed on that. If I hold that in a tax-deferred or a tax-free account, I'm not taxed on that dividend. And also for lower earners in the US, if between you and your spouse you make less than $89,000 in a year total, you're not taxed on any dividends at all. But let's say you own a Canadian gold company and that company pays a dividend. As an American, you're automatically taxed 15% the moment that dividend is paid, even if you hold it in a tax-free account, and even if between you and your spouse you have a low income, you're still taxed that 15% and you can't avoid it. So that's something to consider as well. If you're considering buying a Canadian gold company versus a US oil and gas company, well, you're going to have a better tax situation for the US oil and gas company, at least if you're an American like me. But I know a lot of you watching are from all around the world, and I don't know your personal tax situation. The next reason to buy Devon is we have a decreasing share count. In approximately the last 3 years, Devon has retired about 6% of their outstanding shares. So every year that you're a shareholder of Devon, without buying any more shares at all, you become a bigger owner of the company each year as more and more share repurchases happen. And also on that note, Devon is returning a lot of money to shareholders. And they're doing that in two ways. Number one, they're buying back shares. And number two, they're paying a nice dividend. Now they have this dividend policy where they have a fixed dividend and a variable dividend. They take their free cash flow and they take 30% of their free cash flow, and that goes towards strengthening the balance sheet or paying down debt. And then they take 70% of the free cash flow, and that goes to the fixed dividend, the variable dividend, and share buybacks. So from that 70% of free cash flow, they pay the fixed dividend first. So you can look forward to getting at least 22 cents per share per quarter, because that's a fixed dividend. And then, depending on whether they think their company is undervalued or not, they pay a variable dividend or they buy back shares, or a combination of the two. So some years, this dividend is going to be huge, and then other years, we're going to see the share count drop a lot because the company is generating a ton of cash, so they have a lot of money to return to shareholders. And another reason you might be interested in purchasing Devon shares is they operate in a safe jurisdiction. 100% of their production comes from the USA. On this channel, I talk a lot about gold and precious metals, so I want to compare Devon to a similar company in the gold space. Devon operates exclusively in the US, so they operate in a safe jurisdiction, whereas Agnico Eagle Mines operates mostly in Canada, so Agnico Eagle is in safe jurisdictions as well. And then in terms of the company valuation, the market cap, $29 billion for Devon, $32.6 billion for Agnico Eagle. Enterprise value, $34.5 billion for Devon, $34 billion for Agnico Eagle. One thing I see beginner investors getting confused about is thinking that because one company's share price is lower, well then that company is cheaper. But that's not the case because it depends how many shares you have outstanding. So Devon, you're paying a little over $47 a share, and Agnico Eagle a little over $65 a share. But in terms of market cap or enterprise value, they're almost exactly the same. Considering you're paying the same price whether you buy Devon or Agnico Eagle, let's look at some financial numbers from the companies to see what you're getting for that money. And by the way, even though I'm going to be picking on Agnico Eagle here, it's not because I think it's a bad company. In fact, I think it's a very good company. I think it's a very good gold producer. But I want to give you this comparison because that is a super popular company to own in the gold space. It's one of the most recommended companies you'll hear. It's one that's in every one of the funds, every one of the mutual funds, every one of the ETFs. It's all over the place because it's a very good company. But I want to make this comparison to show you just how cheap Devon is. First up is revenues. In the blue column here, we have Devon. In the black column, we have Agnico Eagle. In terms of revenues in the last 12 months, Devon has earned 2.1 times the amount of revenue that Agnico Eagle has earned. But that doesn't take into account how much it cost each company to get the resources out of the ground. So next is gross profit. So this is revenues minus what it costs to get it out of the ground. And Devon has about double the gross profit of Agnico Eagle. And next up we have operating income. So this is gross profit minus basically what it costs to run the business. And in this case, Devon is almost 3 times that of Agnico Eagle. And keep in mind, you're paying almost the exact same price to buy shares of Devon as you are to buy shares of Agnico Eagle, but you're getting 3 times the operating income buying Devon. And then it's also worth looking at the tax. So these are the tax rates for Devon and Agnico Eagle going back 4 years. So for Devon, we have 18%, 2%, 22%, 18%. For Agnico Eagle, we have 33%, 40%, 40%, 18%. So Agnico Eagle is usually in the 30 to 40% range, and Devon usually hovers right around 20%. And the taxes are taken from the operating income, so the taxes affect your bottom line a lot. And now we have the net income in the past 12 months for each company. Agnico Eagle is way down here at 472 million, and Devon is way up here at almost 3.4 billion. In terms of after-tax income, Devon shareholders earned 7.2 times that of Agnico Eagle shareholders. Now it's worth mentioning that in the past year, the oil price has only gone up a little bit, whereas the gold price has gone up 15 or 20%. So maybe a year from now, maybe it's not 7.2 times, maybe it's 6 times, or maybe it's 5 times. But even if Agnico Eagle grows their revenues by 20%, grows their operating income by 20%, well, Devon's after-tax earnings should far exceed that of Agnico Eagle, despite a higher gold price. And now we still have the same 2 companies, but we're looking at cash flows. So this is cash from operations. Devon, Agnico Eagle. Devon has 2.4 times the amount of cash from operations. Remember, you're paying the same price for each company. And next we have free cash flow. That's what we just saw, cash from operations minus CapEx. So CapEx is going to be what it costs to maintain production and what it costs to grow production. And Devon earned 2.6 times the amount of free cash flow as Agnico Eagle. And this is how much money is being returned to shareholders. Now these bars are negative because it's a cash outflow, because it's going back to shareholders. So here in this column, we have Devon's share repurchases of about 720 million. Here we have Devon's dividends paid of over 1.5 billion. Here we have Agnico Eagle's share repurchases of about 50 million. And here we have Agnico Eagle's dividends of 640 million. And remember, this is the same size of company, and Devon returned $2.3 billion to shareholders, while Agnico Eagle returned $700 million to shareholders. This is one thing where Agnico Eagle has Devon beat, and that is the total amount of debt. So Devon has about $5.7 billion of long-term debt, whereas Agnico Eagle has $1.7 billion. So Devon has 3.3 times the amount of debt. However, when you compare the amount of debt to the amount of cash flow each company is making, well, it's actually not so bad. Devon's debt doesn't look that bad. And here we're going to see that. So this is the cash from operations divided by the interest expense for each company. So on this chart, the higher the number, the better. So here we have the most recent year, and Devon had about 18 times interest coverage ratio, whereas Agnico Eagle had 26 times. So even though Devon's debt is way higher, their interest coverage ratio is not that much lower because they're generating a lot of cash. And I thought this was interesting to look at. This is Devon's debt maturities. So they have $5.7 billion in debt. However, almost $3 billion of that doesn't mature until after 2040. So they have very long dated maturities, and they don't have to pay back a lot of this debt for a long period of time. And their average interest rate is only a bit over 5%. So their average interest rate is pretty darn low, which is why their interest coverage ratio is so high, even though they do have quite a bit of debt. So to me, their debt really isn't a concern. And this is interesting to me. This is retained earnings. So this is taking your earnings, subtracting how much you return to shareholders in the form of buybacks and dividends, and this is what's left. This is the year 2020, 2021, 22, and 23. Well, in these 3 years, Agnico Eagle was negative. But you can see that Devon is growing their retained earnings every single year. And this doesn't mean that they had $6.2 billion in the most recent year, because it takes this year and it adds about another $2 billion in retained earnings, going from $4.3 billion to $6.2 billion. Now, Agnico Eagle has been negative for 3 years, and then finally in 2023, they jumped up into the positive. But because Devon has more retained earnings, that means they can reinvest more money into their business to continue growing their business. And this is another way to look at which one is a better company, and these are each of the company's return on capital. So this is 2021, 22, and 23. In the most recent year, Devon had a return on capital of 24%, whereas Agnico Eagle was about 5.5%. Devon's return on capital was 4.4 times better than Agnico Eagle's. And despite all these facts here, remember, Agnico Eagle is not a bad company. Agnico Eagle Mines is a very good company. It's just that Devon is that much better. And Devon is that much cheaper. I'll get to my conclusions for this investment in just a moment, but I wanted to let you know that in the past few days, I'm seeing some of the best valuations in the natural resource sector that I've seen in a very long time. But you got to make sure you're investing in the right stocks, and you got to make sure that you're following those very, very closely. So in my newsletter, I share with you what I'm putting my own money in, and I tell you what I'm doing before I buy or sell anything. So if you're interested in that, go to miningstockmonkey.com/products/VIP, and that'll take you right there, or you can click on this link right up here. The price is going up on July 1st, but anyone who signs up before then and stays subscribed gets that price forever. So now let's talk about my conclusion for this investment. The price to earnings ratio right now is at 8.74. However, costs are coming down by about 10% in 2024, so I expect earnings to increase, which will bring down the price to earnings ratio if the stock price were to stay the same. But as earnings increase, usually the stock price goes up as well. And then you have a price to cash flow of just 4.44. Price to cash flows like this are typically reserved for declining industries. However, I don't think this is a declining company because they're reinvesting enough to maintain or grow production. Yes, the politicians are saying, we're going to put you oil companies out of business in 2030, and by 2030, everybody's going to be driving electric cars and internal combustion engines won't exist. But I don't believe that. I don't believe the politicians, and I believe that at some point in the future, that perception is going to change once people realize how wrong these politicians are. And now we have the risk level. So 1 being the least risky, 10 being the most risky. A big part of the risk level is buying at a good price. Like if you buy a great company, but you pay a really high price, well, your risk level could be a 10. Because if you're buying in a bubble, well, that's very, very risky. However, here you're buying when the valuations are actually quite good. I am adding a certain level of risk for this because these oil and gas stocks do tend to be pretty volatile, and they could also be the victim of higher taxes, like in the form of a windfall profit tax or something like that in the future if oil prices were to go way up. So for those reasons, I'm putting the risk level at a 4. So overall, this is a pretty safe investment in my book. But keep in mind, these oil and gas stocks are very volatile, so this stock price could easily go down by 30% over the next year or so. And today the stock price is sitting somewhere around $47 a share. And my verdict between sell, hold, buy, or strong buy, I'm giving this a strong buy. I think these are incredible valuations today. And if you buy today and hold for a few years, I think you're going to see very, very good returns. If you're interested in my newsletter, click on this link right here and sign up before the price goes up on July 1st. And next, watch this video. It's my analysis of B2 Gold, and I'll see you over there.